Absolutely. We'll see how this one goes. Of course, big winner for him earlier. 11 and a half higher now. 223 lower on the Nifty, 17,091. Manish Sundalia is with us, Head of Equities, PMS at Motilal Oswal Asset Management Company. Manish, great to have you with us here. Thank you very much. Uh, how are things looking? It's a red screen, but do you think we've seen this before, right? I mean, stronger data, US equity sell-off, market sell-off, but only to be bought back, bid at lower levels. And the relative outperformance still, we fall less basically. It's not as if the market goes up a lot, but it falls less. Will that texture continue to hold? Manish, you'll have to unmute yourself. Thank you.
Sorry. So India has been a relative outperformer in the overall emerging market space, and as long as 20 times or thereabouts prices to earning multiples on FY23 number holds, I don't see how markets can fall drastically, even in the global backdrop of rising rates and whatever has been happening in the US. So the key monitorable is earnings, and I think anywhere between 850 to 900 EPS on the Nifty, if that holds, I think it's a buy on dips market. No two ways about it. Because I think if you look at high frequency indicators, oil has been below 100 for the past 60 days. Inflation is flatlined for most regions of the world. Somewhere it is also declining. No major sector has seen a price increase over the last 40 days. India's PMI is at 55. GST collections at 1.4 lakh crores every month. Realistic assumptions and prognosis by the RBI of 6.7% inflation for India. All in all, I don't think we have serious red flags as far as India is concerned. So, according to me, it's a buy and dips market.
Okay, it's a buy on dips market. So there are no major red flags, is what you're saying. Manish, good morning. How are you approaching some of these spaces that have come out of the woodworks after many years, right? Autos, for example, we were just discussing many large investors buying in, a lot of mutual funds raising their holdings in the auto space. What's happening here? Is this some kind of a structural story? And if yes, what are the key themes that you can still play despite the rally that we've seen?
So I think the biggest tailwind is happening in terms of volumes, and that after a very long time, because volumes are now picking up in a big way. There has been a pent-up demand, and that's getting fructified on the easing of supply side challenges. Quarter on quarter, there has been a fall in raw material costs, primarily steel, aluminium, so it is aiding margins as well. So I think after a very long time, you will see quarter two numbers for automobile companies actually show some robust growth, more on for the OEMs as opposed to the ancillaries. But it's going to be a pickup in numbers, in automobile profit after tax numbers. And that's basically getting reflected in, the stock prices of automobile companies. And I think this rub-off effect will also continue into the third quarter and fourth quarter on the back of whatever we are hearing on the ground, expectation in terms of demand. So that's what's actually changing for the automobile space from being a large underweight. I think this is one of the spaces apart from, let's say, financials, technology. These automobiles would be one of the spaces which will show very good earnings for this quarter. That's what is getting reflected in the stock.
One of the big winners from last month has been Mazagon Dock. And guess what? It's back right at the top with the largest volumes, and it's turned, it's come back into the green. Mazagon Dock at 643. There is a bid, and that's up another 10, 11 rupees. I mean, amazing what it's done. It's up 30%, by the way, in October so far. So just a kind of big mover we've been tracking. Kochi Shipyard is up another 2.5% or so. That is, I mean, these are named Mazagon and Kochi are relative. Mazagon, of course, was a relative, not underperformer, but didn't do as much as HAL or Bharat Dynamics, etc. But it's caught up now. Kochi Shipyard, of course, is another one of those. IT, Manish, what's your view? Earnings will start to come through first off the block. Stocks still are have lost quite a bit. Although some would say that compared to their 10-year median valuations, they are still expensive. Where do you stand there on IT?
So, firstly, on the valuation, see, I mean, as opposed to IT spend globally being a discretionary spend, this time around with the migration to the cloud, etc., it's not entirely discretionary. And a portion of the IT spend which is happening, particularly conversion from legacy systems into digital and all of that, it's more mandatory. If you have to survive, thrive in your business, you got to make that spend. So, as opposed to past cyclical sort of valuation metrics that one is used to seeing for the IT space, I think the valuations will settle at a higher level than what you would have seen in the last 5 years or so. Secondly, I think everything has got to do with how the deal flows would look like for the commentary that's going to come out at the end of this quarter. Because next year's business is going to be contingent on what sort of a deal flow pipeline that we are talking about in the case of the IT companies. My sense is that broadly, in the case of margins, we are broadly seeing the bottoming out of margins. If not now, maybe slightly later within the next third quarter or so, because supply side pressures are somewhat easing at the margin. So all in all, if the sector is corrected by, let's say, anywhere between 30 and 50%, broadly the mid caps and the large cap names, you would see that the price earnings growth multiple has moderated significantly. If you're looking at the margin, EBITDA margins actually, bottoming out, then, and it's a high quality earnings that we are talking about with 70 to 100%, dividend payouts in terms of PAT. Just to understand how the FY24 numbers are going to look like, that's basically what's going to be watched out for in terms of commentary. Numbers broadly would be all right for this quarter. There's nothing that is going to be worrisome as far as this quarter numbers are concerned. Is everything got to do with how FY24 numbers are going to look like, supply side issues, pyramiding, margins, that in a nutshell would be but I would remain positive on the IT space as a case of a buy rather than a sell. And mind you, we are not even talking about the rupee tailwind. Of course, a lot of that cross-currency headwinds would impact on margins, but all in all, rupee tailwind will be felt after a lag. So no reason to be bearish on IT as a space.
So even if today TCS later in the evening, scales down their margin performance, they talk about the demand trends getting slightly adverse, that wouldn't spook you, right? As a long-term investor, if you're holding TCS, despite the caution, you would continue to keep the faith. Is that correct?
100%. I mean, this is one sector which hardly sees any dilution in capital. It's a free cash flow machine. Of course, if FY24 is going to be wobbly, what about FY25? Because in FY25, you'll have again the Fed start to cut rates, etc., and again discretionary spend would come back. So it's a journey in the overall scheme of things as far as the IT names are concerned. According to me, this is one of the best sectors to own in a long-term portfolio.
Okay.
What else? What is it? Number two after IT as a space where one can hunt for opportunities.
So I think all in all, if you look at the trajectory of earnings growth, it's basically financials, autos, industrials, and consumer discretionary. As opposed to in the past year, you had the households actually spending a lot on healthcare. This healthcare spend is basically translating into discretionary spend. So the consumer discretionary, the automobiles as a part of consumer discretionary, IT and financials, and somewhat on the industrial side as well. These are the spaces where one will find the maximum gains. This is the space where valuations and growth would have to be measured, and I think these would be the sectors which will lead from the front as far as market cap increase also is concerned. Defense is also a part of the industrial space. Yeah.
Okay. No, so 2 points. One, would you name what is your top ideas in defense? And second, on financials, apart from the top banks, right? Are there any sort of smaller, niche focused businesses like a home finance company or something on the gold lending side, or you just want to buy some of the larger, bigger banks?
In a rising rate scenario, when cost of funds are actually moving up, basically it's the banks which have a CASA franchise slightly ahead in terms of the pecking order as opposed to the NBFCs. So Plus, the credit growth in the system is pretty decent at double digits now. In spite of rate hikes, 190 basis point, you're looking at credit growth in double digits, more like 13, 14% now for the fortnight gone by. CDR ratios are inching more than 70%. So I think the best is going to come for the banks as a space. And from that point of view, I think valuations of large cap banks are very, very conducive. There's high margin of safety out there. So stick with the large cap banks. That is where I would look out for. Retail credit is very strong as opposed to, in the past. So, you have plenty of opportunities in the financial. As far as the defense name is concerned, I think everything is available at a bargain. For ourselves, we are looked at BEL, Bharat Electronics, and HAL in some of the funds. But there's bargains across the board.
Bargains.
Okay.
I mean, they've done big gains, right, Manish?
So, but you look at Cochin Shipyard, it's still at just about high single-digit prices to earning multiples. Mazagon Dock was available at less than cash value.
Yeah.
So, that's why it's still a bargain.
Yeah.
Okay. Manish, just one thought on, we were talking about the auto space, right? There's lots happening across the world. So we just had the North American truck sales, which hit record highs. And so many companies have an exposure there, whether it's Bharat Forge, Motherson Sumi. Small exposures, but exposure nevertheless. Would that pocket interest you?
We are having a large holding in Bharat Forge, so we have been positive on this name. As opposed to the previous, billing or let's say ordering cycle, this time around in the US, the ordering cycle has been preponed. So that gives you a sense of the demand, and obviously the numbers that have come out has been pretty strong at 50,000 plus. So this time around, the total North America Class 8 truck sales are expected to cross the previous peak. So from that point of view, if let's say for Bharat Forge, if 25% of the automobile business comes from North America, even after moderating high energy costs in Europe, having an impact on margins for the European subsidiaries, I think we're broadly looking at 1,200 crores plus of profit for Bharat Forge at, in this year. And valuations are very, very reasonable. And India's CV business is firing on all cylinders. Let's not forget that. You've seen what the numbers for Leyland and Tata Motors and all of the others, tractor sales are pretty strong. So all in all, again, the component suppliers, particularly on the CV side, are in a sweet spot. So I completely agree with you on that.
All right. We're going to, in fact, take that discussion forward. That's the exact same, thing that we're going to talk about with our next guest who joins in. So thanks, Manish, for being with us. The North America truck sales hit a record high in September, an indication that truck ordering activity has picked up in a big way. Samvardhan Motherson has about 7 to 8% of its revenues that comes from that market. In fact, let's clarify that with Vivek Chand Sehgal, the chairman at Samvardhan Motherson International. Mr. Sehgal, always a pleasure speaking with you. Thank you for joining us.